VCs, private equity, but also principal investors. The family office extensions of ultra high net worth individuals, I know Jay spends a lot of time in that space, that's a very significant universe of potential investors for the early stage businesses. And then of course strategics, most notably defined by Amazon's investment in Living Social and others of similar size.
Sure.
So there's a lot of activity there. On the exit side, it's very hard to take the law of small numbers and apply some general principles from that. Generally, you're looking at revenue multiples now in the 12 to 15x range, which is again, emblematic of the early stage, fast growth, multiples that you'd expect to see. But there's just so little exit activity out there that I couldn't possibly project that as For now, that's right.
Mark, in terms of getting a little more specific with numbers, if you were to invest in a daily deal space or in a daily deal site, what type of a run rate are you looking at? I mean, are you looking at the last 90 days? Are you looking at the last 6 months, the last year? What type of growth curve do you want to see on revenues? I guess with margins as well. Like, what are you looking for? So, at what point does a daily deal site come to you, or would you approach them? Like, what do you need to see mathematically?
Well, I think one has to look broadly at what's going to define a compelling investment. And while revenue momentum is a key determinant, it's really the net present value of long-term cash flows compared to what you're investing and what the risk-reward profile is there. I think that the risk-reward profile has gotten materially worse in a profound way in the daily deal space over the last 18 months, since many companies missed the inflection point of lower cost of member and customer acquisition. Today when you're looking at the cost of a member acquisition, you're seeing in the space, Groupon at $5.60, but they have a special situation because of the billions that they've spent. The reality is I think you're going to see in the industry the cost of member acquisition is going to be well above $10 on average in the industry, except for very niche plays, hyper-local plays and such. But when you're trying to build a large company, more importantly, what's the cost of customer acquisition? Because members do not necessarily convert into customers, and how are you optimizing that? I think that you're seeing numbers out there that people are saying that's $30. I think that number is low with where the industry is trending. I think that number is going above 50. So you start to then look at the business model, an investment case, you're looking at a very crowded space, 370 companies in North America alone. Very hard to define what's your compelling differentiated value proposition, what's your competitive advantage long term, and why is that competitive advantage going to sustain through exit. So I think right now the attractiveness of the sector from an investment point of view, it has to be very targeted and is limited. So I'm not highly encouraged. In fact, I see some people out there raising right now, and a few that have, they're saying there are only going to be a few more large fundings in the space, a handful. Otherwise, I think you're going to see strategics coming in who are, for example, like Infinium with Eversave, where that was an acquisition. There's a natural strategic play there, leveraging off core competencies that Jerry and Eversave had. That's the type of play. You're also going to see niche plays, for example, like TripAlerts.com, where we do travel, very tough part of the value chain. And you're going to see a global play here that hasn't been fully capitalized on, but Groupon, Living Social have really jumped out ahead.
Okay, great. Ben, what are you looking for?
Well, so I look at this space, having been in this business for a long time, very similar to some stories in the past. In the early 2000s, you had the domain name business that blew up, and it got really hot. It attracted a ton of investments, created some really good exits, and then you had the same thing happen with traffic arbitragers in the sort of 2003, 2005 time frame. Some really big companies blew up fast. Nothing has blown up like this space, though. I mean, it's been an incredible run.
But when you're talking about these other concepts blowing up, I mean, they were blowing up from a revenue perspective, but was there true value in these companies? I mean, were there people who were arbitraging traffic? There were some cases when companies sold, and they sold for big numbers, and I've heard of cases of then Google changing the rules the next day after a $400 million buyout. I mean, what do you think of that? What do you think of the fact?
There were some companies that created long-lasting value that have been around for a decade, and many proved that they were very unsustainable. And so venture capitalists are bringing those experiences from looking at those spaces and looking at any new space that blows up like this, that essentially, hey, somebody has a really great new way to acquire customers, and then it blows up, and then everyone pours in. And what happens is you get a couple big companies that blow up on top, and then you get specialized companies that come in underneath that have compelling value propositions. And so what we're seeing now, and what still excites us in the space are the companies that have, very unique ways of getting supply on the deal side, that are solving hard problems that not everyone can go into, and that they're adding a lot of value to the process and building a passionate customer base. There's always going to be a business bringing buyers and sellers together.
Yep, absolutely.
That is never going to go away. But doing it the same way that we did it 18 months ago or 24 months ago, if you're just doing it like they were doing it, then it's not going to be sustainable.
Let me address the next question to the panel. To make the daily deal space more appealing to you as investors, what needs to change? What's the primary thing? What's the lever that needs to be pulled to really, get this thing going?
Well, I think that there are many dynamics. I'll just toss in that, broadly, when you look at the Rice study that came out earlier in the year, I think there is a mega trend here about this is really converting local advertising dollars or potential profit margin on sales of local businesses into a whole new market that really is beyond e-commerce. It's really about marketing and branding and customer acquisition of those local businesses. So let's not forget that it's much more than e-commerce. We're actually a local advertising and branding business for many companies, including global companies that are doing deals, whether it's Gap or other businesses. That said, when you look at the underlying metrics there of local advertising, how large that business is, if we can just take away 5 or 10% of that, it's $5 or $10 billion there of business. So there are very interesting macros there that can make this space very interesting for investment, but it's about the niche plays. And right now, I just think trying to be an all-purpose general competitor of Groupon or Living Social is a death wish, unless you have something that's highly competitively differentiated in supply or and customer acquisition.
So talk to me about these niche plays. What would you like to see? What specifically? Are you looking for the development of specific verticals, branded as separate sites?
Well, I think that, and not to be self-promoting, but just as an example, where TripAlerts.com provides B2B solutions of travel to the daily deal space and to other partners throughout the world, Brazil, Russia, Canada, Asia. That is a vertical in an area that's very hard to curate, design, and provide supply. You need very large volume to be able to negotiate supply. So aggregating the demand, the aggregators, the daily deal sites, to actually create the purchasing power is a differentiated model. And that's a model that has a lot of potential trade sales. That's one niche. There are other niches within the space that can be very defined on certain areas, like family. As an example, although the large players are playing that, you can do it better. You can do it in a purer way where you have more engagement, more community. I think that's one way to actually lower your cost of member acquisition, increase your yield optimization, conversion rates. The global piece is really about having a large capital base. That's a competitive differentiation. Now, we have a few companies that have that differentiation, but they're going to be more than 2 winners globally. And so I think that's another area that one can see a niche that if you're backed by, over 50 million, you can play in that space. I would say it's really over 100, and there's room out there because the market is growing so rapidly. I'm sure the other panelists might have other niches.
What's the next hot niche in your opinion?
If we can put a plug in for our organizer of this conference, I think that service providers to the industry, so like a Daily Deal Media, someone that is building brand around research and analytics in the space, that's something that once you've built it, that you're leveraging all of Groupon's, all of Living Social's marketing budget to attract interest into the space, and then you as a service provider in the space are benefiting from that, as opposed to having to have these incredibly large marketing spends on your P&L. So this idea of niche plays, I think that as you can move up the value chain and offer services into the industry versus simply being a transactional player, while that can be tricky because it's hard, venture firms don't like backing services firms without some scalability component, that a service provider like a Daily Deal Media plays in the industry are interesting. They're niche plays, but they're interesting. So I think it's building on the theme that Mark is talking about, anything that can be done to create differentiation, create barriers around your customer, barriers around your business model, is going to have more, will get more interest from the investment community, because that's just how their minds work. They have these MBA minds that kind of do these Porter's 5 force analyses, and they want to see the business wrapped up in a little bow that makes sense in the context of businesses that they've seen successful in the past and have been written about in all the business books.
Great, great. Chuck, what do you think about a shakeout? You think it's going to happen?
Well, I think we're looking at some of the similar trends that we've seen in other, fast, explosive growth sectors in the e-space. We tend to look at, 3, broad trend lines. There's the early stage, which I think we're just finishing now. And in the early stage, you tend to see the exit early phenomenon for the seller, followed by the caveat emptor phenomenon for the buyer. And I think what you're seeing right now is the potential for pigs getting fat and hogs getting slaughtered. And that always tends to be some of the things you see in the early stage. What I like about this stage that we're entering into now is it's the clear adapt phase. And I'm going to allude to this in the wrap-up speech today. But in that adaptive phase, I think you're seeing models evolve very rapidly to get to the true high value opportunity in this sector. And I think the win phase is going to look very different. I think in terms of the lifetime value models associated with some of the traditional businesses that this business tends to emulate, I think that's where you're going to see the real value created.
Okay, great, fantastic. And I'm sure everybody wants to know this, everybody with a daily deal site. I mean, I certainly wanted to know it before going into my deal. Money off the table. Now, Ben, I know that you're a secondary investment, so let's talk about money off the table and how you feel about entrepreneurs actually cashing out at any stage of the game.
Well, obviously, I'm for it.
so everybody's going to love you.
So look, the reality is, with the exception of this space, in the venture ecosystem generally, it's 9 years to build a business and get to an exit. We've seen some exceptions in this space that have been extraordinary because the initial models were so scalable. And we've also seen that some of these companies are really, really fragile. In that environment, I think it makes all the sense in the world where talent is key to be able to show your talent real value as you're building a business. And so I'm all for entrepreneurs and top employees taking money off the table as they go, and buyer beware. They should be doing their homework on the business and making sure that it's a good deal.
Jay, what do you think? Money off the table.
I
have to disagree with Ben on that. I think it's.
Financial guys always do. That's why the entrepreneur's my friend.
So don't you want to motivate the entrepreneurs? I mean, do you want the entrepreneurs worrying about how they're about making money?
Yes.
You want them to worry about that.
Want them
to be
up all
struggling.
night. Yes. Want them to struggle. Builds character, perseverance. Leads to adversity creates opportunity. Yes. So I think it's an unrealistic expectation for companies, whatever that threshold is. Sure. I guess for companies at a level where they have either, if their shares are posted on second market and they have some market there where their values are into the hundreds of millions of dollars or into the billions of dollars, yes. But the vast majority of companies, and certainly entrepreneurs in this room, these are small companies, and the expectation is for a very long, hard struggle to get to a place where they've built revenues, they've built real profits, before any money could be considered taken off the table in terms of investment going to the selling shareholders. I would say, if I can just add one point there, that in the spirit of having an MBA professor here at the table, make a book recommendation. There's a great book. It's actually like a 40-page PDF.
Did you write the book?
I did not write this book, no. It's called The Early Exit by Basil Peters, and I'd recommend it highly for entrepreneurs running kind of whatever it is, smaller companies, few $100,000, few $1 million in, and the author's main point is with the early exit, let's try to have reasonable small business expectations in terms of value creation. If we can get to a sale of a business for a few $1 million, if you compare that to your other career entrepreneur options, that's a very successful outcome.
Fair enough.
And to focus on that and to think about your strategy there and maybe tune out the venture capital noise, tune out the noise of raising a lot of money, bring in a little bit of money or potentially no money and just try to get to a small exit, that can be a good outcome.
Oh, sorry, I thought we were running low on time, but apparently we're not, and I was trying to rush. Okay, great, fantastic. Money off the table. Chuck, what do you think? Sorry. I apologize. Sorry to interrupt you before I even start talking. I respectfully disagree with you because I mean, you know, and again, I guess it depends on the stage, you know, the stage at which the company's at. But if there's a growth curve and if there's profitability, if the company's not bleeding money by financing it itself, you know, then again, I'm not on the venture capital side. I'm on the other side. I mean, I certainly wouldn't have done a deal without having some kind of financial security. But again, you know, there's different you know, levels that the companies are at, and you're all about secondary.
Yeah, so I mean,
you're like, here's your money, go through a party, but come back to work tomorrow.
In the vast majority of our deals, we're actually aligning incentives between the investors and the employees, because especially in these companies that can blow up really quick with some success, for an entrepreneur who takes $5 million from a venture capitalist and then all of a sudden is looking at a $30 or $40 million exit, that could be life-changing. Absolutely life-changing. But for the VC, it does absolutely nothing. It cannot. If you've got $1 billion fund or a $500 million fund, that you need to make 10 times your money on that deal. And that's what we try and do in every deal. So being able to come in and provide some amount of liquidity and saying, hey man, look, take a couple $1 million off the table and go shoot this thing for the stars is completely aligning. I totally agree. Our minimum investment, is $20 million of revenue before you even start looking at something.
Absolutely.
So we're all dealing with people who have already created real value, real value in their companies. And it could be a very cooperative, very aligning kind of transaction that really gets everyone focused on creating a big outcome.
Chuck, sorry, this is an important question, so I'd really like everyone to answer this.
Yeah, I think we all have great opinions. I think at the end of the day, the market is the best determinant. If there is a willing investor who is willing to allow the owner-operators to take chips off the table earlier, I think that's a sign that the market is in support of both taking chips off the table, wealth creation, wealth management, and wealth preservation, while allowing then the entrepreneur to really focus on building that big business, as you said. So what we try to do is manage expectations, which I think is key, but also acknowledge that if the market's willing to allow chips to be taken off the table, and it clearly has been, admittedly early stage in this sector, there's no reason to not run your business today as if you're planning on an exit sooner rather than later. Doesn't mean you have to exit, but run your business with that philosophy. We always advise entrepreneurs to think that way.
Right, and in terms of secondary, you have to, as venture capital people, you have to take a look at how many term sheets people are getting. So if there's a company that's doing really well, they're on a great trajectory, they're getting 3 or 4 term sheets, and there's a lot of secondary on it. Would you step up? Would you step up if that was the case, or would you shy away from an investment like that?
Well, just philosophically, I like entrepreneurs to be in the hot seat, and I'm an entrepreneur, and I'm totally comfortable with that role. Been in a lot of businesses. I think it's good to have those incentives highly aligned, and I don't generally, as a philosophy, like to see entrepreneurs taking money off the table, but there are strategic reasons for it. And when I've had my venture capital hat on and been running that kind of firm as opposed to an operating role in the daily deal space, I have let entrepreneurs take money off the table, but primarily it's because it's a way to get a deal done. VCs usually want to own 20% of a business, a fund, as a ballpark. And oftentimes you're having a syndicate of 2 investors, and oftentimes the entrepreneurs don't want to be excessively diluted. So there's an issue there that sometimes they don't need as much money as the VCs require to go into a deal or want to have go in a deal. The only way you can make it happen is really to buy some existing shareholder shares also. Yep. And it makes all the pieces come together. And within reason, money off the table, if it's not excessive, if it doesn't take them off the hot seat, is okay. Or I think, as you were saying, if it's really late stage. Late stage is a whole other thing. If you're the CEO of Groupon, fine, go take 25 million off the table. It doesn't really matter at that point. You're already all set.
Yeah, fair enough. Let's talk about expectations for a lot of the people here, at the conference when they're thinking about their daily deal company, the one that they've either just started or one that they've been running for a few months or for a year. Realistically, what are expectations here? What do you look like? What kind of valuations? And I think that's something that everybody wants to know. If somebody's thinking I'm doing $100,000 a month, I'm on a run rate of 1.2 million, 5 million, 10 million. What's my company worth? Does anybody have any thoughts on that?
Sure.
Everyone, you guys are kind of all a little, you're smiling and laughing.
There are lots of ways to value a company. I would say, first of all, you have to look at management execution talent. At the end of the day, business is about execution. Nobody has a monopoly on great ideas. In fact, great ideas are a dime a dozen. So entrepreneurs oftentimes kid themselves about that. What is rare is truly great leadership and management and having a team and having a defined niche to operate within.
So you're back to the specific vertical. You're looking at verticals.
I'm back to a competitive advantage, but now I'm also talking about management team as another dynamic about that and executing. And then that combination really is the key determinant of value, not even revenues. One of my friends was backed by Eric Schmidt, CEO of Google at, I won't say the exact number, but 7 to 10 million pre for a business plan without any team members. So,
pre-revenue.
Pre-revenue. So I mean, that's not uncommon at all in early stage VC with the right talent. There are a lot of people in the room and attendance at the conference who, have businesses that, let's say a company has been rapidly scaling, they've been executing well, they've got a rev rate of let's say 3 to 5 million and a model that works. The key thing here is that you have to have the initial kernel of a scalable model that has a business model you can pump money into quickly. That you actually have a cost of customer acquisition relative to the long-term cash flows that makes sense. If you have proof of that at an initial level of scale combined with management, then you could have a business doing, in this space, 2 to 5 million of revenue that could get 20 million pre.
Sorry, 2 to 5?
2 to 5 million of annualized revenue.
Annually.
Annualized, that would be a 20 million pre. With that combination of a scalable model, good management team, that would be very, very normal. In other spaces, other sectors, you're not going to see that multiple on revenues unless you have those same metrics.
And when you talk about proven, are you talking about executable or projected?
I'm talking about an initial proof that you spend X dollars and that you have a model that works. And I think a lot of people, kind of watch the shadows on the wall as entrepreneurs and have these inspired ideas and creativity, and they, it's worked for other people, or I've got this, new way of doing it. They think that that's cool and it's worth a lot of money. Okay. The reality is it's worth a lot more money when you've just proven that it actually works, even for 3 or 5 months.
What's your take on this,
So
Ben?
my take is, and this is what I have the unique position really of seeing lots of companies from the end of their life, where an entrepreneur is looking back and assessing his decisions.
Okay.
And I can tell you, I have never heard any entrepreneur express regret over their Series A or Series B price. Man, I wish I should have held out for 20 instead of 15. At the time, it feels like a report card. I'll tell you the regrets I hear. This guy was on my board and he was such a jerk and he drove me crazy. Or to get this high valuation, I agreed to all these other terms that now are killing me because I can't sell my company. Those are the two biggies to avoid. Get good partners. Don't worry about your valuation so much. Who do you want to build your business with? Stop, it's not a report card. It's just the beginning of the war. It's the first battle. It's not the whole thing.
To the point of good partners, in the position that you're in, what I'd like to know, and what value add as venture capitalists, as the people coming in, financing these operations, are you coming in strictly with money, or are you bringing in expertise? And I'd like you to address this specifically for the daily deal sector. So if I'm a daily deal site and I can take 10 million or 20 or 50 million dollars from just a guy with a lot of money, or I can take the money from you, how are you going to help beyond the money?
I sign up for smart capital as opposed to dumb capital every day of the week.
Agreed.
And so the definition of smart capital is, exactly your point. It's the insight that you're getting from the investor over and above just the check amount itself.
So specifically, Chuck, what would you bring? So you've invested in a daily deal site, because that's what we're talking about today. You've invested in a daily deal site. You've put your money in, whether they're secondary or primary, doesn't matter. The money's in. Now we want to grow. What are you bringing to the table?
Well, I'll build on what Mark said earlier, and I agree. I think in this adapt phase that we're in right now, the 3 traditional axes of how value gets created in this business, that rule applies. It's the vertical industry, it's the horizontal solution set, or it's the geographies you're in. And at the risk of sounding overly formulaic, I think we're at that stage now where the existing daily deal businesses are going to grow, and consolidate and exit around one of those three dimensions. And the larger companies clearly are placing bets in all three. But I still don't think that's the eventual model for this sector to get to, and I'll talk about that later this afternoon.
Jay, your value adds.
Well, I'd like to, if I could, take your question, then not answer the question.
By all means, by all means. It's an open panel, open for discussion.
I think that all these valuation, smart money, they tie down, looking at it from the perspective of the executive, the entrepreneur, that there's an enormous need to attract high valuation, to attract smart money. It's incredibly difficult. The vast majority of companies are DOA. They're not going to get any term sheet and any valuation. They're going to be put in the spam folder of the so-called smart money investors. So we got to step back, and the points that Chuck's were making about the business model, the team, have to make, in a space like this, a new space where folks are looking for guidance, they're looking for leadership, they're looking for someone, and they're asking the entrepreneur to provide that leadership to say, this is where the space is going and here's why. That's an investor relations challenge. And when you do that well, you then attract the high valuation, you attract the smart money. So I think a lot of times entrepreneurs, they separate the investor relations process from the running of the business process. They're going to raise money, then I'm going to go run the business. It's for spaces like this, they're so strategic and the future is so unknown, you can't do that. It has to be, you have to be the thought leader and put the ideas on the table that attract the things you're looking for.
And I agree with you. And by the same token, my expectation, I guess, as an entrepreneur is if you've invested into my company, we're partners. So let's say, for example, I need a meeting with whoever I need a meeting with. Let's say I need a meeting with Mark, and I can't get to Mark because all his gatekeepers won't let me in. I'll expect to be able to call my venture capital company, for them to have that connection, and for them to have the power to be able to do an intro by email, and I'm talking to Mark the next day, and we're talking about how I can run ads on travel on trip alerts and how we can do a rev share on that. So that's the kind of expectation that I would have, and that I think in general that people who take venture capital would want. And for ourselves, I'll give you an example. Not of course to knock what you guys are doing, because I don't know your infrastructures, but some of the people who invested in us, they'll invite us to seminars and they'll invite celebrity speakers. What do you guys think of that? What do you think of motivational speakers? At one point they invited the VP of the Mets to come and give us a motivational talk to the CEOs. Do you guys do stuff? Do you believe in stuff like this, the softer things?
Yeah, I used to work at Mavron. It's a big firm out of Seattle, and I can tell you that getting our CEOs around Bill Campbell, who's the coach of the Google guys, and the original Apple employees, and Howard Schultz, it was like, that was amazing.
So there's a benefit.
Yeah, come on, we used to have you have private time with these guys who are legends. It's value add. It's not going to make you successful. It'll help. And again, it goes back to the right partner for your business. If I was a daily deal business, I'd be thinking, how can my investor help me get supply, and how can my investors help me get distribution, and who are they going to put on the board, because those relationships are huge.
Okay. Specifically for daily deals, and I know we talked about verticals, and I know we talked about the different opportunities, but specifically for, I guess, what's now the traditional, we're talking about a couple of years, the traditional daily deal site like a Groupon, like a Dealfind. In a traditional scenario, is there still money available? Is there money on the table that's available? Are you guys investing?
I'll answer that quickly. Yes, I was in LA earlier this week, talking to a company who's a strategic. They've already made an investment in this space, and they gave us the profile of other firms they'd like to acquire in this space. As I said, I think we're in the consolidation phase. There's a pause for cause of some sort. So yeah, there's money looking for companies to buy and invest in this space. So
then everyone here who has a daily deal site, who's at least doing some revenue, should come talk to all of you guys after this.
Absolutely.
Everybody open to it? Okay.
I think following up on Chuck's point, I think that these roll-up opportunities in the space are ones that are very popular in the investment community. It's a space that lends itself to scale. So to the degree to which part of the investment proposition is a roll-up component, I think there is a lot of an enormous amount of investment interest for those kinds of entrepreneurs and executives telling that telling that kind of growth story.
Great. Let's talk about, I think, what everybody, we haven't really touched upon it too much, but Groupon's IPO. What are your takes on it? Anyone? Ben, what's your take on it?
My take, I read the S1. I had an opportunities over the course of my last couple of years to participate in various Groupon secondaries. Everybody in the secondary business did. It was nothing proprietary. And prices were extremely high. Look, everything is worth something. And I think the question is, given what we now know about Groupon's business and the challenges they have, we have to recognize they've done something absolutely extraordinary. They've grown faster than anybody else in history. They deserve a lot of credit for that. At the same time, I don't think that the roadshow and this issue has been handled optimally, and people are reassessing the sustainability of their model. In that environment, I'm not a public market investor, but I do have a rule that says, I'm only investing in businesses that I can get a reasonable value today, that I think are going to be around in 5 years, where I really feel that. The valuations that we were talking about, I think, are obviously off the table. I think that it's a matter of resetting expectations, being clear and honest about what's good about your business and what's bad, and then going forward and building your business. The IPO should be a financing event for them, and they obviously have a business there, and I hope that they address those challenges.
Jay, sorry, I have a specific question. Oh, sorry, just jump in.
I just want to say that I think what's going on with Groupon, it ties into the theme of investor relations, and it's the best of times and worst of times for Groupon's investor and public relations. In one regard, they're doing a phenomenal job because they have to be one of the top 1 or 2 talked about IPOs of the last couple of years, so they're getting an enormous amount of press, and they have to get credit for that. At the same time, there's just a lot of cross currents of that press that are affecting the valuation. So it just comes down, it's hard to extrapolate from that experience to what the reality is for everybody else, for the other 1,000 companies in the space. But I think the lesson to be taken is that do your investor relations carefully and strategically, and it makes a massive difference in your valuation.
Chuck, from an accounting perspective, how do you feel about Groupon basically backing out they're trying to capitalize their marketing expenses and showing profit? They changed their minds that way. They didn't change their minds. I think they were kind of pushed into changing that. What are your thoughts on that?
Well, number one, I'm not an accountant. Even though McGladrey, our sister company, is an accounting company, so we look at it, more from the lens of an investor. And I think what's happening is, the market is telling the company how to truly assess and value its business. And that's why, frankly, I'm a huge fan of Adam Smith and the invisible hand, because I do see that at work here, in a very high profile way with Groupon. Now, having said that, I'm also a Chicagoan. We want Chicago-based companies to succeed. There are people's personal livelihoods at stake here, and they deserve their chance to shine. But I do think you're actually seeing the market effect play out in real time, which I think is very good.
What do you think, Mark?
Well, regarding the marketing expenses and the way they were treating them for accounting, I actually think that's totally reasonable because you do have a long-term cash flow. It's not necessarily the way we do it internally in our company, but I don't think that's an invalid argument. I think it's very valid.
Why was it so scrutinized then by the SEC?
Well, I think it's about investor perceptions, and the SEC has certain standards regarding investor perceptions, and that things need to be black and white. And if it can be misleading in any way, that was really the issue. It's about better disclosure of what they were doing, and also they could have shown an alternative second set of books with that done otherwise, and that would have alleviated the problem entirely because it would have been full disclosure. Just one other point though on this. I think the bigger question really for people in the room, because nobody in the room here is Groupon. The question is, what are the exit strategies for our normal brethren here in the daily deals business? And it's not an IPO for 99% of the businesses in this space. So Groupon is kind of off in fantasy land of that 1 in a million that happens to hit the cover off the ball. But what are the exit strategies for our basic entrepreneurs that build a business that's doing 20, 50, 100 million of revenue, which is hard to bring a company public at. And I think we all need to be thinking about who are those trade sales going to be to. And generally, you're not going to be managing these businesses just to pay dividends and have cash outflow. And I think everybody in this room needs to be thinking about what is the range of buyers for trade sales, not thinking about IPOs. What's the size where you optimize value? And really what happens is when you're accretive to earnings for a public company and you can create revenue momentum for that company that's attractive to help their PE, that's when you get optimum value. And it usually happens when you get revenue bases that are above $50 million. Depends on the niche, can be as little as 25 or as high as 100 plus. We need to be thinking about what's the profile.
Thank you very much. Thank you. Oh, that's great. Sorry, we're just out of time. I apologize for cutting you off. Gentlemen, thank you very much. You've given us a really good insight, and everyone in the room, I'm sure, is really appreciative. Thank you.